This is our Forex blog for March 12th, 2013, and we've been working on statistical measures to compare each currency to every other one for the last 7 or 8 years, and our best is our new currency indexes, which basically show each individual currency as if it's a chart. You can see here the Euro index. Okay, it's the Euro across all the different pairs is going sideways, and then it starts to go down. It breaks underneath yesterday's low, but is not able to continue downward. So when it comes back into yesterday's range, that's a bullish signal right here, which would have given you a profitable trade against whatever the weakest one at the time is. When it failed to go above the 15-minute moving average in green, decent place to sell, which would have given you a profitable trade. You might have looked to gone short right here at a resistance area, and of course that didn't really pan out, but you might have made 5 to 15 pips on that. If you believe that the euro was going to get a bounce, the fact that it's not able to break through those lows, once it comes above this swing high right here, you can see for about the next 2 hours it explodes up. It goes over its hourly moving average, the point of control, which is where most traders have positions in the euro yesterday, and yesterday's high. And the fact that typically when previous day's high and low get broken, you're going to get a bounce off of that. And typically they'll come down and do a retest, as what happened here, and then they'll explode up. The fact that it didn't is basically a bearish sign, and it's likely to reverse down. Once it comes back into the previous day's range, goes underneath yesterday's high right here. Let me use my screen drawer. Once it comes underneath this line, this previous day's high right here, pretty decent place to go short, and you can just keep trailing your stop. As long as it's going lower, just put your stop above each bar's high as it walks its way down. Here's the previous day's low. You're expecting support here. The fact that it went through there is bearish. The fact that it came back and retested it, it did not go lower, which is what typically happens, is a sign that the move's over. And so this, having an actual chart of each individual currency can dramatically improve your odds. So let's look at one of our methods of linking all the charts together. If you make them all the charts green, for example, and then you select our option on our toolbar right here, when you scroll one of them back, they all scroll back at the same time. So you can pretty much walk through and practice test using this. And here's some of the things that you want to be aware of. The euro is pretty much in a really tight range. It's finding support at the hourly moving average. It's also underneath the point of control. So underneath the point of control, it tends to be bearish. Above the hourly, it tends to be bullish, and that's why it's kind of chopping around there. The dollar is above its hourly, so its likely direction is up. The yen broke from underneath to above the hourly moving average. However, keep in mind that the daily, weekly, and monthly trend, as you can see here in the circle, is in a downtrend. One of the things you can also do with our indexes is just simply draw trend lines underneath there, and as long as they're above the trend line and sloping up, the trend's up. And you can clearly see our statistical tools are also showing the yen as being strong at this point of the day. Looking at the pound, we see that the previous day's low right here is being held, and you can see that area got a bounce off of yesterday. We also kind of have a trend line over that bar's high, and so now that we scroll over to the right and kind of watch these charts, let me turn the screen drawing off for a second. As we scroll over here, you can see that, as likely, when the euro broke down underneath the hourly, the trend's down. This dollar, which was above its hourly, and you can see it found support at the 15-minute moving average right here, is up. So that's one trade you could be looking for. And by just looking at the chart, you can clearly see the daily, weekly, monthly trend of the dollar is much stronger than the super weak yen. So the odds are, I'd rather take the safer trade. Sometimes it makes less pips, but the rule number one of trading is to not lose your money. And one of the easiest ways of not losing your money is taking the safest trades. You can always make more pips by trading more lots in a safer trade than riskier type trades. So let me bring this chart up real quick. So again, we're seeing that the euro's trend is down, especially a little bit after 2. The dollar is going up, although not at the same intensity that the yen is, but the yen's longer term trend is weaker. So we'll bring up our euro dollar chart, and we can see at 2 o'clock right here broke down and made new lows. And there's a couple trades that you want to look for in trading currencies. One is breakdowns. The next one is a pullback trade. I'm sorry, just starting to get used to using my video software's charting drawing tools. It's got some limitations. So the 2 decent trades that you could have taken, and change the color on this one here, is the breakdown right here and also this trade right here. And with the first trade, I would put my stop right above this bar's high. The second trade, pip or 2 above here. So the beautiful thing about using the indexes charts to make trades is when you're wrong, you're going to lose tiny amounts. And when you're right, typically if you got out of that trade right here, you made the same amount as you risked. The second trade went down about 7 times more than what your risk was. And so that's the real key to trading: small losses, big wins. Let's look at some other examples as we go forward into the day. It's clear that the yen is super strong today. While I will typically not aggressively trade a currency that's this weak, the daily, weekly, monthly trend's down, but when the real-time trend is the stronger of the 2 between the dollar, and it has every opportunity to fail and reverse, but doesn't, typically later in the day, although I'm not trading most of the time at 4 a.m. occasionally, when it breaks out through the high right here, that's a trade right here that I would take, because it had every opportunity to reverse at the hourly moving average. It's exploding up. It's the strongest of the 2 between the dollar and the yen in real time. And you can see as this thing's up near its highs, the dollar is just not able to break out and go higher. So that's what's so nice about having each of these individual currencies as a chart. You can clearly see double tops, triple tops, double bottoms, triple bottoms, and reversals off of those. And when they keep going higher and sit at the highs and break out, typically they're going to go up. So at 4:30, you can see the yen was the strongest. At 4:30, the euro is underneath its hourly moving average, and the dollar just finally broke down after not being strong enough to make higher highs all day. So basically at around 5, you could be looking for dollar yen, or actually even before 4:30, you could be looking for dollar yen sells or euro yen sells. So let's bring up the euro yen, which is probably a higher probability one since it's actually much weaker than the dollar. So 4:30 to 5, or actually let's go back and find the exact time. Yeah, it's around 4:20 is when the yen becomes super strong. And that's when this drop here happens. And more than likely, you might have missed this move right here. But you have the opportunity to get into this trade on a pullback. And so you go short right here, it falls about 40 pips, it pulls back, you go short right there, it falls another 40 pips. Now I'm not using 5-minute charts to trade off of. I use mainly range charts, which is, let's just put a 5 pips per bar chart on here. Each bar is actually 5 pips. And it really lets you see, and I'll take these lines off and I'll use my video recordings drawing tools. It lets you see pullback trades. For instance, right here would be a good example of going short. Anytime it goes my way, then kind of goes against me, I'm watching it like a hawk right here, and I would have probably been out of this trade right here. Unfortunately, just a few minutes later, it goes up and can't break over the high here. I would have expected it to. So once it goes down again, you can go short right here. If you're a little bit more conservative, you can wait for here, and then you just trail your stop over you know, the bar, 2 bar backs high, or use our trailing stop and so forth. But you can see that trade right there generated maybe about 30 pips. Got a nice pullback right here. This is a good example of a trade that went our way, came back, didn't stop us out. At this point, I'm kind of expecting maybe the trade to fail, so I'm really trailing my stop really close, right above the bar's high. And when it goes sideways like this, you know, obviously I'm expecting it to reverse. Now, because it made new lows, I probably would have went short right here and had a loss. Gone short again right here. Decent trade, got back the loss. Short right here. It went down and kind of went sideways. It just made a higher high than before, so typically I'm going to move my stop to right around break even. I would have probably lost 2 or 3 pips net on that trade. But that's how you use our indexes. And of course we have these for all the indexes, not just the 4 pairs. Those are the 4 main ones. Here's the Swiss. You can see a lot of information on this chart. For one, it had a false breakout right here. So if the daily, weekly, monthly trend was down, you could, you know, look to sell right here. This one's kind of a mixed bag. The daily trend slightly up, weekly trend's up, the monthly trend's weak. You could certainly sell that because it is a very high probability trade. The fact that it went up to the previous day's high again later and then broke out. Typically, currencies don't fail at the highs twice. They will fail a lot of times the first time. The second time, usually that's a trend that's going to continue. So this is one of those trades you definitely want to go heavy into. And you can see for the next hour and a half it went up. So at 9 o'clock, what was the weakest one? Let's take a look at some of these here. 9 o'clock, the CAD is underneath the previous day's low. It certainly could go lower. The Australian's strong, and New Zealand's kind of just going sideways. 9 o'clock, certainly the pound looks to be an excellent one to be selling against. Why? Because it went underneath yesterday's low, exploded down. You have incredible weakness here, which typically is going to result in a reversal. And I would have, you know, probably drew a trend line on this and gone short right here and had a small loss. Unfortunately, I had to get back in. And so the pound looks to be the weakest one. Trying to find the currency that we found here. Okay, so it was the Swiss. So the pound was the weakest. Swiss was one of the strongest at 9. Let's go back to the 5-minute chart so we can see the whole day. Pound Swiss is a good one to sell, and coming up to 9. And you can clearly see a nice pullback. Yeah, a false breakout here. And at 9 o'clock it breaks the lows right there. And you can see it fell 60 pips. And you can just use our trailing stop, or, you know, typically every time it goes down and makes a new low, move your stop down to reasonable levels, you know, and typically the farther it goes, the more likely it is to reverse. And I haven't been going over one of our new tools very much lately, so this is a perfect opportunity to show our perfect oscillator, which in this case very likely is going to show you that this is in an extreme move. And a lot of times when price goes underneath the -80 level, you're going to get a reversal. So this has gone statistically too far right here, and when it goes back inside the Bollinger Bands on my perfect oscillator, that's typically the best time to be trailing your stop. So right here it went back in. That means the downward momentum is slowing, and if you want to use a trailing stop on your chart, you can tighten it to maybe a 1x trailing stop when you see that happening. So you can zoom in here. This is kind of an advanced method that I use. We have 20 different layers on our chart, so I will keep up a chart that I can use to put trailing stops on and know what the levels are. So at this point right here, the momentum was slowing. I'm using the 1 trailing stop, and I would have probably been out at the close right here at 43. So in somewhere around 87, that's a 43 pip move. And you can also use once you have a trend that's down, you can use our Bollinger Bands to know when to get in. In other words, when this closed up right here, notice the price oscillator is right at the upper Bollinger Band. The trend's down. This is what I consider an extreme place to be when the trend's down and you want to sell it. If the trend's up, you certainly don't want to sell the upper band. You want to look to buy the lower bands. In other words, right here, the trend on the move up is, you can see you got a nice little pullback right here. This is where you want to look to start to buy, and you can see it went up. Typically, no matter what the trend is, when the price hits the upper or lower band, it does tend to stall and reverse. You can see it hit the upper band here, went sideways for a couple hours, came down here. That was the end of the little down move. And this is based on the volatility of that time of the day. So that's why I call it the perfect oscillator. It doesn't use periods. It uses the past 20 days statistics.